Welcome to Business Insights Daily. I'm your host, Seshank. Today, we're diving into one of the biggest media mergers of the year. Charter Communications and Cox Communications have agreed to join forces in a $34.5 billion deal. This massive transaction will create the largest cable TV and broadband provider in the United States, overtaking Comcast. Both cord cutting, accelerating, and streaming services dominating consumer attention. Why are two cable giants merging now? Let's break it down. Charter, best known for its Spectrum brand, acquiring Cox Communications is a deal valued at $34.5 billion, including $12 billion in debt. Once the merger closes, Charter will rebrand as Cox Communications. Spectrum will remain as its consumer-facing name. Charter will pay using a mix of cash, convertible preferred units, and stock, giving Cox a 23% stake in the new company. CEO Chris Winfrey will lead the combined firm, while Cox CEO Alex Taylor will become chairman of the board. The headquarters will remain in Stamford, Connecticut. Atlanta, Cox's base, will become a key operational hub. Timing isn't everything. Why merge now? This merger isn't coming during cable's golden age. It's quite the opposite. Traditional pay TV is in free fall, losing subscribers quarter after quarter. Broadband growth has also slowed due to stiff competition from fixed wireless providers like T-Mobile and AT&T. So why merge now? The answer lies in survival and scale. By combining, Charter and Cox hope to streamline operations, achieve $500 million in cost saving within 3 years, and strengthen their position against streaming platforms and telecom providers. A regulatory test in a post-cable era. 10 years ago, this merger would have been dead on arrival with antitrust regulators. Today's market dynamics have changed. Cord cutters ravaging traditional television, regulators may see merger as less as a threat, competition, and more as a last-ditch effort to stay relevant. Though scrutiny is expected, especially in a regulatory environment that remains cautious about corporate consolidation. So what's in it for Cox? Number one, a bigger stake and a consolidated future. Cox, previously a privately held company, will walk away with 23% ownership stake and significant board representation. The Cox family will become the largest shareholders in the merged entity and gain the right to nominate two directors. Importantly, Charter will also absorb Cox's commercial fiber, managed IT, and cloud businesses, potential growth areas as consumers' broadband stalls. What was Wall Street's reaction? Cautiously optimistic. Investors responded positively to the news. Charter stock rose 4.5% in pre-market trading following the announcement, and analysis maintained a moderate buy rating on Charter with a price average of $423.44, though many warn the potential growth remains stable, limited, and given the market challenges. This merger is more than a numbers game. It signals a fundamental change in the industry shift towards cable. Instead of chasing TV subscribers, cable operators are pivoting towards bundling mobile services, boosting fiber investments, and consolidating operations to reduce costs. As we wrap up, Charter and Cox's $34.5 billion merger is a bold bet on consolidation in a shrinking market, and a sign of times where being big may be the only way to stay alive in an industry being refined by mobile connectivity and streaming platforms. Thank you for joining us on Business in Touch Daily. I'm Shank, and I'll see you next time. Stay informed and stay ahead. Thank you.